Happy 4th of July. The markets had a very strong June, driven by the big 7 stocks that have catapulted the market higher. The rest of the market is up marginally, 3-4%, but the big 7 has caused the S&P to be up mid-teens. So it's been a very strong start to the year. My caution, which I reiterated at the end of January, has been misfounded. I was cautious for multiple reasons, but it appears that the liquidity in the system that was presented during COVID and going back to 2008 was enough to provide enough liquidity to drive the market higher, even in the face of some very difficult circumstances. So in March, we had a period where the regional banks began to show some cracks from higher interest rates, and we had a little mini regional bank crisis. That appears to not be over, although the worst may be behind us, but it does look like it's going to spill over and be accelerated by commercial real estate, which is becoming very problematic. So that's still here in the future. In addition to that, with that regional banking crisis, the Fed unwound a lot of its quantitative tightening and produced about $400 billion into the system to help save the regional banks and basically reverse quantitative tightening. We're back about to even with that quantitative tightening reversal. So a lot of that has come back out of the system, but we're clearly way behind the schedule that the Fed had promised with regard to quantitative tightening. So those two items, the reversal of quantitative tightening and then all the liquidity still sloshing around the system, managed to press stocks higher, even in the face of slowing earnings, down earnings year over year, and continued slowing economy. The regional bank crisis is going to create a credit crunch that's going to be more difficult for businesses and consumers to get loans. In addition to that, the federal deficit is running completely out of control, and the debt ceiling crisis just highlighted that event. But we're now going to be issuing about $1.5 trillion between now, between the debt ceiling crisis resolution and the year end in new net federal debt. That's just a huge number. We're eventually going to start to see squeezing out of the private sector by the federal government as they continue to run these huge deficits. So $1.5 trillion now between now and year end, maybe another $1 trillion in the first half of next year. It's just a huge amount of money that's going to be going into treasuries as opposed to going into private sector capital projects, private sector spending. So that's going to be a huge drag on the economy. So going forward, I do think that the economy is weakening pretty considerably here, and I do think we're in a rough road as far as the economy. With regard to the markets, as I've been saying the whole time, it's very difficult to say how this is going to play out. We've never been through this experiment where we've tried to roll back a massive quantitative easing where the balance sheet went from $800 billion to almost $9 trillion over a 15-year period. So that's an experiment that has never been conducted. In addition to that, we've never have been in a deficit situation where we're running these huge, massive deficits that are adding a couple $1 trillion a year to the debt pile, which is already at $32 trillion. So that compounding effect, interest payments on that, interest rates have gone up, is going to end up making the deficit situation, there's no way to be fixed. So I've been wrong to date, being cautious since January. The market has clearly moved up pretty strongly. I do think caution is still warranted when you look at the facts around all the conditions with regard to quantitative tightening, restarting, the federal deficit spinning out of control, the credit crunch, but clearly I've been wrong to date. So I'm remaining cautious. I'm keeping an above average level of cash, and that's what I'm doing for my personal portfolio. please take a look at our website where you can sign up for emails and text alerts, and also take a look at our full disclaimer on buildingbenjamins.com. I appreciate your time and have a great 4th. Thanks. Bye.